Welcome back. The big market event of the day, without much question, is something that will happen just after markets close today. That is at 4 p.m. Eastern Time, when Donald Trump is expected in the Rose Garden at the White House to announce new reciprocal tariffs. Let's talk to our first guest of this hour. Jay Hatfield is founder and CEO of Infrastructure Capital Advisors. Jay, thanks a lot for joining us. You're critical of the timing of this announcement. You think substantial tax reductions should have taken place before this tariff announcement, correct?
Yes, thanks for having me on, Paul. So we actually were okay with modest tariffs if paired with a larger corporate tax cut. But now we're getting almost the polar opposite of that. At least there's a potential to have 20% across the board tariffs. Hopefully we don't get that. That would be very damaging to the U.S. economy, but of course economies throughout the world. So we have very, very high tariffs, and there's even discussions on the U.S. Tax bill to have higher rates, which is a disaster for growth. So it really seems like this administration stumbled badly and mistimed this. They should have paired the tariffs with the tax bill so that the drafters of the tax bill could take that in consideration and have deeper corporate and personal income tax cuts.
And one takeaway you said is that the Fed, which you believe should be cutting rates right now, is effectively frozen. Explain.
Well, although the Fed chair said that the tariff increases were transitory, which is a quizzical way of describing it, I would say one time. It's also bad to harken back to the great inflation where they were talking about it being transitory. So, but he seemed to understand that it's a sales tax, so you should ignore the increase in prices. But then there's other Fed members who are claiming that there's follow-on effects. So they seem to be deer in the headlights, don't know what the impact of the tariffs are, whereas most rational economists are predicting that if we have a 20% across the board increase, we're going to have a recession in the U.S. So obviously the Fed should cut. So it's sort of you have an incompetent administration, an incompetent Fed, and a toxic brew. Hopefully we get a better outcome than the 20% across the board alternative.
Right, and you, a short time ago, you said that 20% tariffs, which you hope do not materialize today, but it's certainly possible, would be disastrous for the U.S. economy and other economies around the world. Do you believe, Jay, that in months ahead, if economic data deteriorates in a big, big way after the imposition of steep tariffs, that we will see the administration retreat at all?
Well, I think that's quite possible, and they can use the excuse of coming to an agreement with other countries. But the only offset to that is the Fed almost certainly will cut then, because as soon as it starts hitting employment in the U.S., that's their obsession. They're Keynesian economists, so they're very, very focused on the employment side, which they should be, but they ignore the monetary side as well. But that's why they're terrible forecasters. But they're obsessed with the labor market. So if we get any labor market weakness, probably not this Friday, but next couple months, we'll get rate cuts, which will be an offset to the horrendous tax increases.
You're neutral on the stock market right now, but you think a lot hinges on the tax question that you've just outlined. You say the outcome of the tax bill creates a 1,000-point swing in your S&P 500 year-end target.
Yes, we're not a big fan of momentum targets. So a lot of strategists have lowered their targets just because the market's weak. So we don't believe in that, but we are focused on the corporate tax rate because that drives earnings and then, of course, stock prices. So far, so bad. So I think the most likely case right now is 6,600 for our target. So in other words, no improvement in corporate taxes. I think that's a huge mistake on the administration's part. I don't think the populists in the MAGA movement understand that those corporate tax decreases is what really drove U.S. economic growth. And so it seems like the Congress is off track, the administration's off track, and so that's going to limit the upside this year.
Okay, you're cautious on the market overall, and you say there's great importance lying in the outcome of that tax bill. You do like, however, the big investment banks, Goldman Sachs and Morgan Stanley, from a stock point of view.
Absolutely. Just only beware that the first quarter was not exactly an investment banking boom, so you might get a little disappointment. Although I would guess that's already in the price because the stocks are off 15 to 20% from their highs, at least. So we do think that notwithstanding having to lower our target 6,600, that's still a good year, up 10% roughly. You're going to have deregulation in the U.S. on the merger side, should get some tech IPOs. It's going to be back half weighted. So we think the pessimism about the investment banks is way overdone right now. And even in the face of potentially weak first quarter earnings.
And you also like Amazon and Broadcom. Tell us why.
Well, Amazon is nice for this type of market because it's sort of half Walmart. So their retail business is pretty resilient and it's becoming more profitable because they're cutting costs. They're doing more advertising. So I think people have missed the cost cutting part of it. It's not just a momentum AI stock. They do have AWS, but a lot of cost cutting, much more profitable. And Broadcom, we think it's an underappreciated AI play. They do XPUs, so they're application specific semiconductors that the hyperscalers use, and is now trading at quite a reasonable multiple. So we think that all those stocks were way oversold during the kind of normal March sell-off and should do well in April and May when we get into earnings season.
Jay, thank you very much for this conversation. That's Jay Hatfield, founder and Chief Executive Officer